Several Chinese stocks look like they were liquidating lower this past week, dropping so fast, so significantly in short order. And investors are wondering what is going on. Are their fundamentals just falling apart? Is it a macro? Is it a specific news item? I'm going to talk about all this and more. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I own stock and a few of the securities mentioned. And so let's look at this. For example, YUMC China dropped like about 30% in just a couple of days. Super fast drop, not the only one. You look at Alibaba. Alibaba is now trading below what it was when it IPO'd many years ago. It's around $86, a share now versus around $100 when it first opened up. So you're talking about a long period. Keep in mind, they went public in like 2014. So you're talking about 7 plus years, where you're looking at investors that for the most part are now underwater. There's a slight period here where, maybe you were buying it cheaply in 2016, but for the most part, most investors pretty much since then are looking at a loss. And so it sort of makes you wonder, well, what's going on? Because you look at, Alibaba and you say like, they're growing each year. It's not like they're just posting year after year of losses and the business is shrinking. So what's going on here? I whenever you're looking at something like this and you see, the stock price just fall significantly, you want to check the underlying fundamentals and also cross-check it against, valuation. And here it is. I mean, it's amazing to see, for example, the price to sales multiple across its history has just been coming down further and further and further. So as the company has gotten cheaper, it's really primarily driven off of valuation. People are just saying, hey, I'm willing to pay less and less for this company. Now, once again, with Alibaba, part of this is warranted given the fact that I'd argue their competitive, advantage has been eroding. They haven't been taking as much share. Some competitors are likely taking share. So that's specific to Alibaba, which has been getting hammered recently. But a lot of Chinese equities were also down. I've done, deeper dives into Alibaba. You can check out my latest video on it. But I'd argue what's really going on with the Chinese stocks, at least, in the very near term, is you see this headline, Wall Street Journal, Chinese stocks plunge after SEC stokes delisting concerns. So I think folks are getting increasingly worried about a delisting. You talk about how the Securities and Exchange Commission has notified 5 Chinese-based public companies they could be delisted if they do not allow their audits to be inspected by the Public Company Accounting Oversight Board. This is really just saying, look, there was this Holding Foreign Companies Accountable Act, which was passed in 2020. This is effectively saying the Public Company Accounting Oversight Board in the U.S. doesn't really like how companies in China are currently being audited. So if they're trading on the U.S., they need to be by an auditor that they approve of the process and the bookkeeping. And they're saying, look, we're not really comfortable with this. And here are the 5 securities that could likely be delisted in the near future. And the reality is, it's not just these 5 companies. It would be all of the Chinese companies, but these are the Chinese, all the Chinese companies that trade on the U.S. exchanges, but these are the ones that have filed their recent, annual reports. And so this is what the SEC is responding to, saying, hey, this law was passed in 2020. We're, giving you a formal notice saying, hey, you're going to get delisted. And so this includes Beijing, YUMC China, Zilab, ACM Research, HUTCHMED. So these are just the 5 on this provisional list. I would expect the list to grow. But to make it very clear, the delisting would occur in 2024 if it's not worked out, before then. And you're talking about nearly 300 Chinese companies that would effectively face this delisting, 273 Chinese companies. I personally look at this and I'm like, it's not really that big of a deal for me. The Chinese equities I own also have the listings, in Hong Kong. And for the most part, I prefer to own it there. If it does get delisted, you could have some sort of short-term volatility, some sort of pressure. You might have some forced sellers because maybe some local U.S. brokers won't allow you to hold the Hong Kong shares. I personally use Interactive Brokers for my Hong Kong investments. And so I look at this and I'm like, yeah, this might create short-term volatility. But the reality is volatility is the friend of long-term investors if you study the fundamentals and you say, hey, has the company's fundamentals eroded or is this just a price development? And so I look at this and I'm like, okay, this is noise. This is causing investors to panic about Chinese equities. I'm personally not that worried about it. Interesting to see that the China Securities Regulatory Authority responded to this very notice from the SEC effectively saying, look, we oppose the wrong practice of some forces politicizing security supervision. And they're saying we're willing to solve the problems of inspections and investigations of relevant firms by the U.S. regulatory authorities. They're talking about working through it. They're talking about how they've recently made some positive progress. We'll see whether or not that's enough, whether or not this is just, nice talk or actually leads to some action and ultimately leads into these Chinese companies not getting delisted. But I think it's very clear that China ultimately, they want to take, center stage at the global perspective. And that means, having their own financial exchange that, that's where they list things over time. So I would expect more and more of their companies to be encouraged to be filing, with the Hong Kong Exchange, as you consider this. I ultimately, as I've already expressed, I think it drives short-term price volatility, but not necessarily fundamentals. Now, what can impact fundamentals is the macro, and you are seeing a hit with the macro policies and impact and credit in China, talking about how lending to households drops for the first time in 15 years. And so this is an interesting data point. Whenever you're talking about effectively credit drying up, that is a potential problem because credit drives an economy. So if you see credit, contracting, whether or not it's tied to, let's say, the property sector or consumption, when you see credit tightening, that does hurt growth. That makes it harder to grow. Now, that is generally more of a short-term cyclical thing of like, are we expanding with credit or are we contracting? A lot of that's driven by the central bank there. So that is something to, to keep in mind. But it is, an unfavorable data point. You see Bloomberg also calling out about how effectively looking at Chinese bonds, whether or not it's onshore or offshore, the offshore bonds are pointing to a level of stress with Chinese developers. This is suggesting that there are problems there. The last bear standing on Twitter, he's been calling this out for quite some time. Michael Burry actually called out his tweets, a few months ago saying this is really spot on, where, he's effectively calling out the bond prices for many of the top developers, Chinese developers, and how their bond prices have fallen apart from 100 cents on the dollar to 30, 40 cents, maybe even low as 20 cents on the dollar. This is actually really important because oftentimes credit, i.e. loans, lead equity. Oftentimes you see the stressors in credit before you see it with the stock prices. And seeing this does reflect, okay, there is probably a broader economic challenge going on in the property sector. Property is very big in China. So as you see this aspect, this means that there might be this give and take where you're going to have to see effectively the central bank in China potentially step up a lot more to sort of offset this underlying stress. Because if you have property developers effectively, being traded like a distressed junk bonds, that means the credit isn't flowing. That means new projects aren't getting built. That means new money isn't flowing to all the workers that help build these things. So it does. You do see how the gears of commerce start slowing down in scenarios like this, and over and over again, you almost always see credit lead equities. And so seeing this stressor might be part of what's causing Chinese stocks to also fall. So not only are you seeing the delisting concerns, but you might also be looking at some macro concerns as well. And then another data point just this week that has come out that, might be part of the reason why some of these Chinese equities are really getting hit is it's interesting to call out Tiger Global. They are one of the largest hedge funds in the world, managing tens of billions of dollars in both private and public equities. They have had significant losses so far this year, talking about greater than 20% loss so far this year. And it was interesting to see them talk about doing a $1 billion capital raise. Normally, when you're looking at like hedge funds, why do you need to raise money like that, like a loan to the hedge fund? Like, these are supposed to be extremely cash generative businesses. So it does make, I'd argue, some investors a little nervous. They could say it's talking about working capital loans, but is this sort of like they need the money for a margin loan type of event, or what's going on there? And it might be a big nothing burger, but it is interesting to see that looking at, let's say, their top 5 positions, their top 5 publicly traded positions, 4 of their 5 top positions were down 7 to 8% today alone. And this does make me, think that this could be a targeted liquidation by Wall Street. This is, when Wall Street smells blood in the water, it's like a bunch of sharks just lean into it. Because if they say, okay, here might be a large fund that might be having pressure, they might be a forced seller of some of these positions, we should lean in and just start shorting the heck out of their positions because we know they're going to be forced sellers anyways. And so that might be a dynamic that you're seeing here because, look at those top 5 positions. Now, they're not, for the most part, only one of them is a Chinese equity. But, he does have, Alibaba and PinDuoDuo, which were also down significantly today. So this might be part of a broader, basket of folks effectively leaning against Tiger Global. And that's certainly a possibility. So there's some real challenges here. And I've talked about them before, my concerns with Alibaba. What would cause me to say, hey, you know what, now we're getting a green light? Because I'd argue a lot of what I've called out so far is like big red lights between macro and, potential targeted liquidations by the hedge fund. The delisting is less about a fundamental impact and more about a price impact. Could cause short-term pain in terms of volatility. But, I look at the companies, I'm judging them based on their fundamentals. And, I look at the price action, I'm like, whatever. Is this company still executing? And, for the most part, the Chinese companies, I predominantly own, I'm very pleased with their execution. And honestly, like one trades, effectively the company is trading below liquidation value and another is effectively growing and quickly taking share at, 20% plus growth and profitable. So I look at things like that and I'm like, okay, I still like, for the most part, what I'm seeing. Even Alibaba's, still trades at a very low multiple. And I did a whole separate other video on that if you're interested. But what would cause me ultimately to start buying more? And I think really what I'd want to see is the moment from the central bank in China effectively say, hey, we are all in to make sure this economy is on fire. This economy does really well. We recognize that there's a problem with the property developers. We recognize that their bonds are trading where they are. This might turn into a banking crisis. And so I would want to see effectively the central bank pull out the bazooka and say, we are all in. We're going to do as much money printing as we need to make sure that things start working out again and that the economy is humming. Because you do see this across a couple of different companies talking about a tougher macro picture in China. So that's what I would want to see before I start going, okay, now I'm going to be making that big bet. Now I'm super excited. Like I already have, a sizable position. It's certainly gotten hammered. I did trim, like for example, I did trim Alibaba. I called it out in that video, several months ago, effectively around 160, 170 bucks a share, where I was like, look, their results aren't as good as I expected. It does look like they're losing share. So now it's gotten even cheaper. At what point, will I personally pull the trigger? I think for something like this, for Alibaba and the other Chinese equities I'm considering and own, it's hey, I think I'd lean more heavily into this when you're getting the support from the government and there's money printing involved, and that would make me more confident. And if you're interested in following, more along the lines of my personal investment journey, check out unrivaledinvesting.com. Click join the journey. We have an exclusive server where I'm interacting on a regular basis. And look, we're all looking to learn, myself included. And so I really enjoy, the posts from the Unrivaled Nation. They oftentimes have a lot of interesting thoughts. People are sharing what they own, what's in their portfolio, or posting about interesting companies. And so if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, talking to you about why these Chinese equities are likely coming under some sort of liquidation, coming under immense pressure, and at what point I personally would be looking to buy a lot more. It's a combination of looking at the fundamentals where it's just like, oh my goodness, these fundamentals and this valuation is just so compelling. Plus, I'd like to have the macro support as well from their central government effectively saying, yeah, we're going to be, offering that bazooka. We're going to be easing incredibly, and that sort of aspect. Thanks so much for tuning in.